And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It is The Real Investment Show. I'm your host, Lance Roberts, and glad you joined us. Here we are halfway through the month of September already. So this has particularly been an interesting year so far, obviously, because of the whole virus, the lockdowns, the shutdowns. Now, of course, we're about to run into the election. So, 2020 is one of those years where now people are going, I just wish it would over. Let's get into 2021. Maybe it'll be better. But very interesting here because, what's happening in the economy is a very kind of a bifurcated economy. Some areas of the economy are doing very well. Others really aren't. And it really comes down to jobs and employment as well. If we kind of look at, where jobs are being found, they're in some of the lower wage paying jobs in the country, retail workers and restaurant workers and those type of things, areas you would expect. And then in some of the upper areas of the economy and the larger wage paying jobs, we're not seeing recovery as fast. So a very different economy, really, depending on where you kind of look at things. So, one of the other aspects of what's happened during the shutdown has been a lot of innovation. This has really changed the way that businesses are operating. More and more companies are figuring out, hey, you know what? I can have all my employees operate remotely. For a long time, it was a big concern that people working at home, well, they weren't as productive. They were doing other things. They weren't committing to the job, so to speak. Well, it's turned out that maybe that's not quite true. People are operating and working at home quite well. And a lot of the beliefs that companies had about remote work have really been kind of shattered all of a sudden, and not due to something that they just said, hey, let's try this out and see how it works. It was because of the forcing of those decisions due to the shutdown. So this really has ramifications going forward for things like commercial real estate. A lot of companies were building, big buildings. Before the, as an example, here in Houston, before we actually had the economic shutdown, we had about 6 million square feet of commercial office space that was not rented. The question now is how much more commercial office space will you have if companies start figuring out, hey, you know what? I don't need as much office space. That's a big expense for companies. And, this is also one of the other aspects about what's happening with the shutdown in the economy is that this is actually beneficial for corporate profits. So one of the things to keep a watch on is that while you have an earnings downturn in terms of sales slowing down because of, you've got 30 million people unemployed, they're not spending as much, those type of things. While sales may slow down, bottom line corporate profitability is going to be, or at least have some benefit, right? Some tailwind, because you've got less expenses, right? So, a lot of the shutdowns, people working remotely, less employees, those type of things, that's all cutting expenses for companies, which will increase bottom line profitability and help give it some support. So, that's been really kind of one of the positive side effects about what's going on. And of course, also talking about things like, less traffic fatalities because less people are driving on major freeways, less smog and pollution in major cities. So there's actually been some positive effects. And, like I said, there's been a lot of innovation. Like, for instance, this guy in Australia, he's a former private investigator, and he's called the Coffin Confessor. Now, you got to love this job. He goes to funerals and he confesses secrets of, the people that have died. So if you've died and you've got a secret that you want to reveal, like one of the funerals that he went to, the wife had passed away, and he showed up at the funeral and he reveals that, she also slept with her husband's mother and father. So, and the other thing that he does is he also gets rid of anything that you don't want anybody to know about. So he's like the coffin confessor / cleaner. So he gets in for a cool $10,000. You can hire him to do this. He makes $400,000 a year with this gig, doing this.
Dude.
And if you do a quick search in Houston, there's nobody doing this. So there's your opportunity. In this, if you live here in Houston or in Texas, ain't nobody doing that gig. So if you want to show up at people's funerals and confess sins for people, I know a lot of people just do that for free. It'd be fun. So
the next YouTube sensation.
Exactly. All right, quick look at the markets here as we get ready to open up this morning. Last week we came down, and we've talked about this over the last couple of weeks in our newsletter, that we were set up for a correction in the markets. We kept saying, 5 to 10%, very likely. That's exactly kind of what happened here. A little bit more on the NASDAQ. NASDAQ a bit under more pressure, but it's also been the index that's leading over the course of the last few weeks as well. But in both cases, we've come down and now have tested and retested the 50-day moving average. Now, we're going to try to get a small bounce this morning. The big challenge is going to be getting above the 20-day moving average. That's going to be short-term resistance here, but we're likely going to see a bit of a rally this morning. Again, not a strong rally, but it looks like we're going to get a little bit of a rally today. So kind of watch this. We're still on a money flow sell signal right now and on a MACD sell signal. So those are not extremely oversold yet. So we've got a little bit more work to go here. But again, the markets are working very diligently here to hold that 50-day moving average, which has been really major support for the markets ever since really kind of the March lows. They've been running along this 50-day moving average on this advance. So again, look here for a little bit of an advance here in the markets today. Keep a watch on that. Also watch the dollar. The dollar is very interesting here because it was very weak here for a few months ago. It's now starting to rally. That's putting a lot of pressure now on oil prices. Stronger dollar is not good for commodities, but the stronger dollar is actually good for Donald Trump's ratings. There's actually a very close correlation between President Trump's ratings and the strength of the dollar. So the dollar is starting to show some signs of improvement. We've talked about this for a while as the dollar got very, very oversold, due for a rally. We're watching that now, and that's going to potentially also help lift U.S. stocks as money flows into the dollar, but that'll be weaker for things like commodities and international stocks as well. Okay, quick break. We'll come back. Lots of stories to get into this morning. I'm your host, Lance Roberts. Don't go away.
Hey, do it now.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Welcome back to the show this morning. It's 6:17 as we get today underway. I'm Real Lance Roberts. And of course, get by our website, realinvestmentadvice.com. That's where you will find our latest newsletters, blog posts, videos, all the other stuff we do. Lots of stuff going out there every day. So just get by the website, realinvestmentadvice.com. So a couple of stories out over the weekend that were interesting from the standpoint of kind of things that we're seeing, currently in society. Of course, we're seeing a lot of the social justice kind of things that are going on right now, and then, and of course, the riots and, the idea that, we need more government redistribution and those type of things. And a lot of this, as we've talked about before on the show, is that, this is being indoctrinated into the younger generation through the universities. And, we see a lot of this in some of the course descriptions and those type of things. And this brings up a financial point that is a bit interesting. We've talked about this, before on the show, is that there's a potential for a very large wealth transfer from current boomers to millennials and Gen Zers, coming in years. So as boomers get older and pass away, then those assets will transfer to their kids. And assuming there's assets there to transfer, obviously. And so we've talked about the importance in the past of, setting up,
trust and, doing some proper estate planning. But also importantly, and what happens with a lot of these trusts is they're kind of boilerplate written. And, they say, well, at 25, the child will get 1/3 of all the assets. At 30, they'll get another third. At 35, they'll get all the assets, right? Well, I don't know about you, but when I was 25 and 30, I was not financially responsible. If you give me a big chunk of money, I'm going to go out and buy a big car, a fast car and a big house, right? I mean, just because I didn't understand the value of earning money and having money and understanding the importance of keeping it, right? And that's just stuff you just don't learn until later on in life. And that's the way it is with most people. But what's interesting is that a lot of families don't have estate plans, and they have them set up to where at very young ages these assets will transfer. And this is why a large majority of families, the wealth, when it transfers, rarely survives the first generation because it gets spent, right? And gets put into other things. And this is why we've talked about on the show before about making sure that you set your trust up in a manner that where the children will live off the rewards of the trust, right? But they never actually get access to the principal. And that way it passes from one child to the next and creates a legacy. And so you set up a 4% withdrawal rate. They can take the interest off, they can take the income off, but they can't touch the principal. And this may be about to become a more important structure now. Before, we were just simply talking about it because, well, it was simply a function that you just didn't want the money to get spent on kind of frivolous things, right? You wanted to make sure it would last through generations. And now, though, the issue is that there's a new thought process, and this was something Jim Reed from Deutsche Bank was recently talking about, that this whole idea of social justice and reform and all this that has now been kind of indoctrinated into young individuals coming up through colleges has now set it up that when they get the assets, they're going to self-redistribute those assets to these other causes, right? Giving to the poor, whatever it is. Funding social justice, whatever their thing is, which means that, without having to earn that money, they don't have the respect for what was put into earning that money. So it's very easy for them to divert it into other manners to fight their personal causes, personal battles, etc. So this may become a much more important issue in terms of estate planning coming down the road, where individuals who have earned large amounts of money want to ensure that it will stay within the family and feed their future generations, not just one generation, but multiple generations. And, this is like the Kennedy fortunes, right? The Rockefeller fortunes. Those were structured, Ben Franklin as well, structured his estate so that the principal could never be touched. It could only be, for example, for Ben Franklin, his estate is that the money could only be invested into treasuries, into bonds, and the principal could never be touched, right? The income be taken off, but that's it. And so those fortunes last for generations. They continue to grow and compound and grow and compound, and now they're, very large, vastly wealthy families. Again, for a large majority of individuals that receive inheritances, it typically fails to last more than a generation because of lack of control and lack of this. And now with this kind of indoctrination of individuals coming up, right, that with these more kind of liberal ideas, that's the risk that this money will no longer stay within the family. It'll quickly be redistributed in terms of these wealth redistribution plans that seem to be a thing at the moment. However, while that's Jim Reed's assumption that this will occur, there's also the reality that it may not. And the reason I say that is that there's an old saying that says, if you wanted to change an individual's perspective from liberalism to conservatism, give them money. And, it's different for a lot of people when they actually get money. All of a sudden, they do become much more conservative about it and have different thought processes about just giving it away. But it is going to be a challenge. And this is why, when we talk about financial planning and estate planning, these type of things, you really have to kind of think about the risk more so than the gift. And, when you think about, look, I want, for instance, myself, right? I have a trust for my family. When I pass away, my kids will be taken care of, but they have very strict requirements. And I've talked about this on the show. By the way, I always get pushback for this. Every time I say this, my kids have to have a college education. They have to have a full-time job, and they have to pass a random drug test if they want to get access to the income that the trust produces. They'll never get access to the principal. They'll get access to the income. I had a client of mine. His were very close to mine, except his children had to marry a Catholic. He was a very devout Catholic. So you can put into your trust whatever instructions are that you want to put it in. Any value that you have in your family that you want to make sure that endures through your family legacy, that's up to you. You can put whatever you want in these. These are your instructions from the grave. So, you can have the Coffin Confessor show up at your funeral and say, by the way, you'll have to marry a Catholic if you want access to Mr. Jimmy's money. But the idea is that you can have in your trust, in your will, you can have very explicit instructions. The reason that mine is set up the way it is I just want to make sure that my children are happy, healthy, productive citizens of society. That's what I want. That's my goal. And I don't want to provide a structure that allows for something different. Right? I don't want a Paris Hilton, as an example, running around and doing crazy stuff. That's not the goal. I want my family to be safe and secure and happy and healthy, but I don't want them to be entitled. I want them to be responsible. This is, when I talk about making my kids go to work, I always get emails like, your kids are in school. They don't need to be working. No, they need to be working. They need to learn responsibility for money. They need to understand where it comes from and why it's important. They need these values. And you may not agree with the way I raised my kids, but that's the way that I was raised. And so I kind of passed down my dad, right? So, you kind of pass it down through your family. But, we have these conversations, we have these conversations with our children at home all the time about the importance and the value of work and dedication and being timely and being punctual and being polite and being respectful, and that these values are important for long-term success. And if you do there are certain things that you do. There was a recent article out saying that, the reason that, wealthy people are wealthy is because they're punctual, they're timely, and they put work first, right? And yeah, that's generally why they're wealthy and successful, because they put their work and their time and effort into perspective. Now, take care of the families too, right? So it's just an interesting dynamic that's coming up, and this mental attitude change that we're seeing in the country today from what's these more, and again, and I want to be clear. Well, I'm talking about liberal and conservative ideas, right? I'm not talking politics. I'm not talking right, Republican versus Democrat. We're not talking about that structure. We're talking about the idea, the social constructs of conservatism and the social constructs of liberalism and the ideas and what they foster. And, what engenders economic growth and prosperity coming out of those. That's the ideas that we're talking about here. And, while social justice has, may be important in your views, it may not be in your views. That's up to you. The value of what creates economic growth and prosperity is what we should be focusing on, right? and we've talked about before is that the issues with a lot of these riots and uprisings, etc., is of course has a rooted cause that is current, but people, when they're generally happy, healthy, financially secure, they're not out in the streets rioting. And so the problem has been for the last several decades, and it has been decades, it's been a very slow erosion. And we've talked about this on the show before about the widening wealth gap, the wealth inequalities that have occurred in the country that have led to this. And now the views are by millennials that, well, when I inherit the money from my evil baby boomer capitalistic pig parents, I will then redistribute this in accordance with my social views. The question for parents is going to be, is that what you want your financial legacy to be? But that's up to you. But that's why, proper estate planning and really thinking about what you put in to your estate is so important, because that is truly part of the legacy that you leave your children. Be right back.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
And welcome back to the show this morning. It is 6:34. So a couple of interesting stories. Softbank has been kind of in the highlights here for the last, few weeks in particular, particularly over their issue of the options trading that they were doing and really kind of driving the options market and particularly the tech-heavy NASDAQ to very extended levels. And, of course, that kind of ended last week. But they were directly involved with buying a lot of these call options that they made a few $1 billion doing this, but also drove the markets up with it. But SoftBank has been not in the news just for that, but also over their really kind of disastrous investments into WeWork, which was the kind of the office sharing space, and they were just grossly overvalued relative to its office space that you rent out to people, right? I mean, it's finite in terms of your revenue. You can only charge so much rent, and you can only have so much space to rent at a time. So the multiples that people were investing into WeWork were just astronomical, and of course that whole bubble came to a very rapid, ugly conclusion for SoftBank. And then also, not to mention their Wirecard issues, which has now been globally named wire fraud. So they just had kind of one disaster. But this is what happens, right, with when you get into these kind of bubbles, these unicorn bubbles, where people put together some type of app or some type of product, and they go out to market, and everybody's chasing it because they think it's going to be the next big thing, Uber, Lyft, whatever it is, and they just grossly overvalue these companies for what they can actually generate and earn. And things typically turn out badly when you do that. And SoftBank's run into a spate of problems here just recently that has really impacted their share price. And part of this whole call option thing was to try to put some cash back on the books. They were trying to launch a second, what they call Vision Fund. Got very little uptake on that after the first Vision Fund performed so poorly. Not surprising. And so now SoftBank is trying to figure out some other alternatives. Well, part of what they are doing now is also selling off some assets to raise some cash. And it's interesting because NVIDIA, which is the semiconductor company that you find in a lot of your virtual reality, but primarily NVIDIA chips and video cards are used heavily with video gaming systems, computers built to video game with, because they have very high processing rates, virtual reality, but also they also produce chips for Bitcoin mining. A lot of their chips have been used primarily for that. that stock has been on an explosive run. It's up about 500% in the same time frame that NVIDIA that SoftBank bought another company called ARM, which makes processing pieces that they paid about $31 billion for back in 2013, I believe. So here it is a few years later, and SoftBank, in order to raise cash, is now selling their ARM company, ARM, to NVIDIA for $40 billion. So over the course of the last few years, while the market's been running higher, has had, is up probably in that time frame, 40, 50%, they're selling a company that they bought for not a whole lot more than what they actually bought it for. They'll make a little bit of money on this, but, it's at the end of the day, they're not making a huge profit. This is pretty much a liquidation event to raise capital for SoftBank. SoftBank, their leader Moshe Son is now talking about even taking SoftBank private because the stock price has been under pressure, obviously, because of what's been happening with these issues. So NVIDIA will wind up being the clear winner here. Ultimately, they're going to pay about $40 billion for ARM. And SoftBank technically loses again on this deal. They should have probably just bought options on NVIDIA. Been a lot better off. NVIDIA is look, and just because of this, I wouldn't run out and buy NVIDIA stock, by the way. We've written about this a few times. NVIDIA is currently trading over 20 times price to sales, which they can't grow the company fast enough in any term over any time frame to justify those valuations. It's very much part of the bubble sector right now in the markets. There will be a substantial correction in the stock price at some point simply because it's so heavily overvalued. It may take time, and it doesn't mean it can't go up from here, but just warn you that if you're going to wind up chasing NVIDIA, or if you're already long NVIDIA and are thinking about buying more, I would be cautious here only because it's grossly overvalued. You will pay a price for it at some point. The only question is when. It's always interesting, that investors say, well, if you bought it here and it goes up another 30%, that's great. Well, that's only great if you sell, right? The problem is most people never sell the peak, and they wind up giving up all their gains plus more when you have the correction. So this happens repeatedly throughout time. But it's just something to pay attention to. And it's interesting because SoftBank has been just all over the news lately for a variety of reasons. And you have to wonder why people keep stepping up and ponying up billions of dollars to give to SoftBank to invest when their track record has really not been all that spectacular, particularly as of late. You have to kind of wonder what's the due diligence process that's going on when they're investing in these companies. If you keep winding up with companies like WeWork and Wirecard and others that have turned out to be basically nothing more really than frauds. So anyway, outside of that, Gilead's also going to be buying Immunomedics for $21 billion. That's a new deal. And, a lot of this really in the healthcare space is still this kind of chase for a vaccine. And again, markets are up today on hopes of, a rapid vaccine approval. Lots of people talking about, from the president down, talking about hopefully a vaccine in the next month or so. Interesting chart out this morning, though, says that the number of people willing to get a vaccine, if it's available, continues to decline. Have you ever listened to one of these drug commercials on television for like depression drugs or like the drugs for what's that skin psoriasis? And it says, here's this drug for depression, and it'll make you feel so much better. And then very quickly they run through all the side effects that it might cause everything from, skin lesions to growing a third foot to death. But if you'll take the drug, you'll feel a lot better. But if you actually listen to the side effects, I mean, they're pretty horrible outcomes.
Scare you to death.
I know, right? They're pretty horrible outcomes. And this is for drugs that have been on the markets for quite a while, right? They've been through testing. They've been through, the normal FDA approval process, which takes a long time. And they've been on the markets long enough that you've seen the side effects. And so they know what these side effects are. And if you ever listen to these drug commercials, you have to wonder why or if, people really would run out to get a vaccine that has been rushed through the testing process and hasn't really had time to develop a lot of the side effects. When you can go back through history and talk about things that were over the counter like Fen-Phen, right? And turned out to be, a massive lawsuit because they found out that Fen-Phen caused, massive heart problems. So, the problem is that with vaccines in particular and being rushed through a testing phase is great. They've been tested, but you don't know what the long-term side effects are, that it may take some time, take quite a while for it to show up. Does it form some type of cancer or have an impact on your heart, your liver, your kidneys, these type of things that we may not find out for, a couple of years or more, right? It may take longer than that to find out what some of these side effects are. So you can kind of understand the reason that people might be just a hair hesitant about running out to get injected with something that's been rushed through a test. It's kind of like, a new car comes out and they say, we got this great new hyper car. It'll do 300 miles an hour. We haven't really tested it yet, but we'll sell you one.
You go first.
Exactly. We got this new parachute that we've developed. Would you like to test it for us?
Jetpacks.
Exactly. So anyway, all right, we'll be right back right after the show. Don't go away.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Carry on my wayward son. There'll be peace when you are done. Lay your weary head to rest. Don't you cry no more.
And welcome back to Toast Morning 647. So Brent and I are going to be lobbying one of our partners here for a change of venue for our office.
Oh?
Yeah.
Where are we going?
The Maldives.
Oh, I saw that.
You saw that?
Yes.
Yes. So the Maldives is
I'm in.
is really kind of one of these paradise areas. It's in the Indian Ocean, crystal blue waters and temperate, environments. And basically this in the Maldives, they have these over the water cabanas, but they're not really cabanas. These are like luxury suites. They're 2-story. They've got a slide that goes out of the top story into the ocean. So, I mean, but they are now coming up with a work from paradise package, right? So you can go to the Maldives and you can rent one of these over the water cabanas for up to 4 weeks at a time. The shortest is 2 weeks, and you can do 2 weeks, 3 weeks, 4 weeks. And you can rent this, and they will outfit it with a computer and a fax machine. I don't know if anybody actually uses it. Yeah, does anybody actually use a fax machine? But they'll outfit it with, all your technology, so you can go work, have remote work from home in the Maldives, right? I don't know how you call it work from home, but my remote work from whatever it is, the Maldives. You do this, and then you get a little tired, a little stressed out. Just go kind of jump in the crystal blue water, swim around a little bit, then kind of go back to work. Very productive. This is a very productive atmosphere. You can do a lot of work. It's a $23,250 luxury remote working package. The temporary office hideaway can be booked for up to 21 days, which would set a person back for $52,000 altogether. So
why don't we just buy one?
You can't afford one.
And when you're on vacation, we'll lease it out to somebody else.
Well, you can't buy it. It's just part of a resort. So, but for a cool $52,000 for 21 days. Yeah, that's
money.
That's chump change, right? That's just
expense. Business expense.
But it's absolutely gorgeous if you actually take a look at the pictures of it.
Man.
It's if you just kind of Google Maldives office, right? You'll be going, I want to try to figure that out. So, and honestly, I don't know why cruise ships. Cruise ships are having a really tough time. Trying to get people going to a cruise, obvious reasons. But that's what they're doing is convert all these cruise cabins into remote work offices, so you can go cruise around the Caribbean and work.
I love it.
and they have the floating buffets so you can eat while you're working.
24/7.
Exactly. There's lots of innovative opportunities. You just have to think about these
Have to
things.
know where to look.
I have a boat. We go out for a 3-hour tour.
It's named after a small fish, isn't it?
Yes. People are going, what's he talking about? Gilligan's Island. You have to go way back when, okay?
Yeah, not the Love Boat.
Yeah, exactly. It's funny because my wife and I will talk about these old shows on television,
Yeah.
right? Things that we grew up with, and our kids just look at us like, y'all are just no clue whatsoever. But they just think, so we'll try to get them to watch it, and they're like, this is the most stupid thing. And I have to admit, when you go watch Gilligan's Island now, you go, why was this a primetime television show?
Why was this funny? My sister got my 91-year-old father to finally watch The Jetsons.
Really?
He had never seen The Jetsons.
Wow.
And he's going, wow, this is all coming true.
Exactly. So, all right. A couple other things here as we get ready to kind of wrap up the show this morning. A few things that are, going to be important this week is the Federal Reserve has another meeting this week. And, of course, now this is following the Jackson Hole summit that we had last month, where they talked about their new average inflation. So what they're going to do now, their new policy tool for directing monetary policy is to average inflation over like 3 years. What this basically gives them carte blanche to do is just keep interest rates at zero forever, right? So as long as in other words, if you get a spike in inflation for 1 year, say we have a sharp run up in oil prices for one reason or another, we have a war breakout in Iran or something, right? And there's a sharp run up in oil prices for a year that translates into inflation. Well, the Federal Reserve won't recognize that as an inflationary push because it's only 1 year. So they'll average it out over 3 years, and that gives them cover to say, yeah, we understand inflation's higher right now, but over the last 3 years it's been low, so we're not going to raise interest rates. So this is pretty much just cover to allow them to maintain ultra-accommodative policy basically forever. They can kind of do whatever they want now. This new policy tool removes all the restrictions. Before, if we got to full employment and we had, inflationary pressure starting to rise, what they call price instability, right? You got rising inflation. Then they would start using higher interest rates and tightening monetary policy, et cetera, in order to combat that. Now, this new policy pretty much removes all those constraints. And they're talking about now is that they can tolerate full employment down to 2.5%. The United States has only had employment or the unemployment rate at 2.5% once in its history, 1953. Now, why was that important? It's important because after World War II ended, you had Johnny come marching back home again from the war, and all the women that had been working in manufacturing plants, et cetera, went back home to raise kids, raise families. The men came back home and went to work. And we had an explosion of economic growth at that point because we were now the manufacturing epicenter of the entire world. I mean, Britain, England had been bombed out by Germany. Germany had been bombed out by everybody else. Japan had been bombed out by nuclear bombs. I mean, you go through the entirety of the world at large, and there was only one country left standing for the most part, and that was the United States. So we were the manufacturing hub. We manufactured everything. So yeah, in 1953, we had the lowest unemployment rate in history of 2.5%. It was the only time we ever got to 2.5% unemployment. We are no longer that manufacturing epicenter. We also don't have a labor force participation rate that suggests that we are anywhere close to having full employment. But because we have a shrinking labor force, in other words, we just count larger and larger numbers of individuals as no longer part of the labor force. We just don't include them. I'm sorry, Brent, you've been out of work for 6 months. Well, we're just not going to include you anymore in the labor force. Well, he's still over here wanting a job, just we don't count him, right? So that leads to artificially low unemployment rates. But it doesn't mean we have real full employment like we had back in the 50s and the 60s. And this is why in the 50s and 60s, yes, we had rising inflation, but we also had rising wages. We had rising economic prosperity. We had very low debt ratios. And the economy was growing very strongly, had high savings rates at that point. So that was the environment that led to the boom in economic prosperity that really has fostered through the last 30, 40 years. And we've been slowly chipping away at that because we're now moving more towards a service society rather than manufacturing, which has basically a very low, what we call multiplier effect in the economy. You get less benefit of each dollar that is produced. But also you have lower rates of productivity. And technology has now reached the point that is becoming a replacement for productivity. So in other words, it requires less input from workers, right? So technology makes us more efficient and reduces our productivity. And this is why we continue to kind of be mired along at these lower rates of economic growth. We don't have inflationary pressures to speak of. In fact, we have more deflationary pressures than not. And this is going to be one of the challenges for the Fed going forward in these hopes that they're going to get to a point to where we actually have real inflation and that we have real economic growth. And this is the important key about this, right? Price inflation alone is not good inflation, right? If healthcare costs go up and rents go up and food goes up and oil prices go up and general retail prices go up, without a subsequent rise in wages, that is not healthy inflation, right? That is inflation that leads to weaker economic growth, worse prosperity, et cetera. What the goal of the Fed should be is to create economic prosperity, which the byproduct of that would be inflation, because as people are becoming more prosperous, they're now consuming more. Their wages are going up because they're becoming more prosperous, which means producers can now raise prices to meet rising demand, which then ultimately leads to more profitability for companies, which leads to higher wages, which leads to more consumption. And you get a virtuous cycle, I should say, that leads to stronger economic growth and rising inflationary pressures in a good way, and higher interest rates. The problem for the Fed is that everything they're doing in terms of fostering more debt, higher deficits, these are all deflationary impacts that have an economic detractor, leads to slower economic growth. So if you do get higher prices, you won't get the subsequent rise in wages because everything is now pushing wages to the lowest common denominator. And if I can't get low wages here, I'll outsource those to the lowest wages wherever they exist, whether it's Mexico, South America, China, India, wherever, Africa, wherever I get the lowest wages. That's just the process of dynamics in the economy. And this is the one thing that eludes the Fed in their policies. But they're meeting on Wednesday. Don't expect any big changes. They're not going to come out and really announce anything new. But expect them to talk more about this idea that we're going to get inflation, but it's going to come from the fact that it's a process of their policy, which is to average inflation over time. I think, though, without any type of real substantive conversation about more liquidity or more support for the economy, that the markets may take that a bit negatively. So again, while we're getting a rally today, and I think that's, and we discussed that in this past weekend's newsletter, by the way, we highly expect a rally this week because we're oversold. It's possible we could run a little bit of trouble later on this week because of the Fed. So again, a little bit of risk. Don't take everything just at face value, and be a little bit careful here. We'll talk some more about this tomorrow. Get by the website, realinvestmentadvice.com, and we'll see you tomorrow on the next edition of the show. Stick around. Chris Salcedo, though, is coming right up.